Breaking oil just touched $126 a barrel, its highest level in 4 years, and this is not just a spike, this is a signal the global system is under stress. Tuesday update. A major shift is unfolding in global energy markets, and it is happening fast. Oil prices surged today, briefly touching $126 per barrel, the highest level we have seen in 4 years. And importantly, this is not happening in isolation. This move is directly tied to rising geopolitical tensions, particularly around one of the most critical energy choke points in the world, the Strait of Hormuz. Now here is why this matters. Roughly 20% of the world's oil supply moves through that narrow stretch of water. That means even the risk of disruption, not actual disruption, just the risk is enough to send markets into panic mode, and that is exactly what we are seeing right now. Shipping activity in the region has already slowed. Insurance costs for tankers are rising. Some vessels are waiting instead of moving. And when supply slows, even slightly, prices react immediately. This is not speculation, this is how energy markets work. Now here is the second layer to this story, and this is where it becomes a global issue. Oil is not just another commodity, it's at the center of the entire economic system. When oil prices rise, everything connected to it rises. Fuel prices go up, transport costs increase, and industries like airlines, shipping, and logistics all become more expensive. And that cost does not stay there, it passes through the system. Food prices rise, manufacturing becomes more expensive, and inflation starts to climb. So when oil hits $126, what you are really seeing is pressure building across the entire global economy. Now here is what makes this moment different from previous price spikes. This is not being driven by demand, it is being driven by uncertainty. Markets are not reacting to increased consumption, they are reacting to fear that supply could be disrupted at any moment, and fear-based markets are always more volatile. They move faster, they overreact, and they are harder to stabilize. That is exactly the kind of environment we are entering right now. Now let's talk about what exactly is driving that fear. The core issue is control over key shipping routes, especially the Strait of Hormuz. Tensions in the region have created a situation where even a small incident, a warning shot, a vessel interception, or a blockade signal can trigger a massive reaction in oil markets. Because the stakes are extremely high, if that route is even partially restricted, millions of barrels per day can be delayed or rerouted, and there is no quick replacement for that scale of supply. That is why traders are pricing in risk, not just current reality. Now here is the third layer, and this is where it gets more complex. Major global powers are watching this very closely. Countries that rely heavily on imported energy are already adjusting strategies. Some are increasing reserves, some are securing alternative routes, and some are simply waiting to see how far this situation escalates. Because right now, nobody knows where the ceiling is. $126 may not be the peak. If tensions continue, prices could move higher, $130, $140, even beyond, depending on how severe the disruption becomes. Now here is the key question markets are asking: is this temporary, or is this the beginning of a sustained energy shock? If the situation stabilizes quickly, prices could pull back, but if tensions continue or escalate, this could turn into a prolonged energy crisis. And that has serious consequences. Economic growth slows, inflation becomes harder to control, central banks are forced into difficult decisions, and governments face increasing pressure as costs rise for consumers. Now here is another important point that is not being talked about enough. Even if oil supply is not fully disrupted, the uncertainty alone can keep prices elevated. Because markets price risk forward, they do not wait for disruption to happen, they react to the possibility of it happening. And right now that possibility is very real. Now let's bring this back to what it means today. Oil at $126 tells you three things. First, the market believes the situation is unstable. Second, the risk of disruption is being taken seriously. Third, confidence in short-term stability is weakening, and that combination is powerful, because once confidence drops, volatility increases. Now here is what to watch next. Watch shipping activity in the region. Watch any military or naval movement. Watch official statements, not just what is said, but what is not said. And most importantly, watch the price itself. Because oil prices are not just numbers, they are signals. They reflect what the market believes is coming. Next.